After a pullback, if the following three patterns appear, don't hesitate. This is highly likely to indicate that a major upward trend is about to begin, accompanied by consecutive limit up days. In other words, if you can master these three patterns, even the most cunning big players cannot hide their moves, allowing you to easily seize the opportunity of consecutive limit up days after the pullback. The first pattern is a low volume limit up, followed by a Doji candlestick pattern, indicating that the market is in a consolidation phase. On this day, the limit up is accompanied by low volume, breaking through the previous platform. On the second day, the price rises and then falls back, leaving a long upper shadow, seemingly indicating an impending, sharp decline. On the third day, the price bottoms out and rebounds, leaving a long, lower shadow. This candlestick combination is a classic Doji candlestick pattern, indicating that the market is in a consolidation phase. The core logic is simple. A low volume limit up indicates that big players have locked in a large number of positions, but these trapped positions have not been completely cleared out. Big players will use the Doji pattern, rising first and then falling, to shake out weak positions. When the market consolidation ends, and the consolidation is confirmed, the best entry point is when the lower shadow appears. The second type is the V shape after a limit up. In this example, after hitting the limit up, the stock price consolidates above the limit up price for a long time, and the candlestick pattern resembles a factory shape. During the consolidation period, the candlesticks mainly consist of small positive and negative lines, occasionally interspersed with some Doji stars. The key is that the stock price never falls below the level above the limit up price, indicating that large investors are secretly accumulating shares and are unwilling to let the price fall so they can buy at a lower price. The entry point is also clear. When the 5-day and 10-day moving averages begin to converge and bend upwards, it is a good entry point. The shape of the 5-day and 10-day moving averages resembles an old duck's head, when the duck's beak shape appears. When this pattern appears, it is time to enter the market. This pattern indicates that the market players have a high degree of control over the market, and the upward momentum often exceeds expectations. In addition, we do not need to take on excessive risks. The third type of limit up pattern, followed by the N-shaped reversal structure, has three key points. First, the first or second limit up must be accompanied by high trading volume. The trading volume at the time of the limit up is significantly higher than the trading volume of the previous few trading days. Ideally, the trading volume at the time of the limit up should double, because trading volume precedes price, and only trading volume can bring about significant market fluctuations. Second, the trading volume during the pullback must decrease. The trading volume during the pullback should decrease significantly, and should not fall below the lowest price at the time of the limit up. It is possible to fall below the lowest price during the day, but it must fall back by the close. This indicates that the market participants are providing support. Third, the timing of buying at a low point should be combined with the overall market sentiment. Generally, when the stock price stabilizes near the 10-day moving average, it is a good time to enter the market. This forms a pattern. This is a classic N-shaped reversal pattern. If the market sentiment is very bullish, the stock price may surge near the 5-day moving average. Taking this stock as an example, it hit the limit up on the day, and the trading volume was also significantly higher than before. Subsequently, the stock price fell back, and the trading volume decreased, but it did not fall below the lowest price of the limit up. Our entry point should be near the 10-day moving average. After the stock price stabilized here, we decisively entered the market, and it subsequently hit the limit up for 3 consecutive days. A word of caution: don't get too fixated on chart patterns. It doesn't necessarily have to be a standard Doji pattern. For example, some stocks have a short lower shadow on the second candlestick, but still surge afterward. The key is to understand the intentions of the market's major players, to weed out those who are bearish. Don't let chart patterns limit your thinking. That's all for this episode.